Welcome back, everyone. Today, we're diving deep into a topic that has captured the imagination of many investors, particularly within the crypto space: the reality behind price targets and market caps. More specifically, we're going to unravel the mechanics behind a particular altcoin that has been stirring up discussions among both seasoned crypto veterans and newcomers alike. If you've been browsing social media lately, you've likely seen the wild predictions, then the emotional excitement, and countless claims about this coin's inevitable rise to astronomical prices. But what we're going to do today is separate the noise from the data. We'll explore what these raw numbers actually mean, not just on the surface level, but in terms of feasibility, investor psychology, liquidity, and market structure. Because in crypto, it's easy to get swept up in hype. What's harder and far more valuable is developing the ability to interpret market data with a critical eye and realistic expectations. That's the focus today, digging into the facts, understanding what they truly represent, and building a framework for intelligent investment thinking. Let's begin with a simple snapshot, a current overview of the coin that's become a hot topic. Right now, this token is sitting at around the 151st position in global cryptocurrency rankings. This places it firmly in the mid-tier range, not obscure by any means, but certainly not in the elite class alongside Bitcoin, Ethereum, or other top 10 giants. Its current trading price is approximately 0.00418 cent, which means it's trading at less than half a cent. Its market capitalization sits around $375 million, and the daily trading volume is in the neighborhood of $15 million. Now, to some, these numbers might seem underwhelming, even trivial. But for others, especially those who understand asymmetric investing, this is where things get interesting. These seemingly small numbers often indicate potential, not guarantees, but possibilities. The coin's trading volume, while modest compared to top-tier assets, still represents active interest. Its market cap shows that it's not vaporware or an abandoned project. It's real, it's functioning, and it's sitting in that sweet spot where a compelling narrative, strong community support, and favorable market timing can spark explosive growth. Now let's talk about market cap, a term that gets thrown around constantly in crypto discussions but is often poorly understood. Market capitalization is calculated using a straightforward formula: price multiplied by circulating supply. That's it. So when we talk about a $375 million market cap for this coin, we're simply saying that the current price 0.0041 cent multiplied by the total number of tokens in circulation gives us that number. But here's the catch. Market cap does not represent how much actual money has been invested into the project. It's not a reflection of liquidity. It's not a bank vault filled with $375 million in cash. It's a valuation metric, a theoretical number that helps us understand where a coin stands relative to others in the market. This is a common misunderstanding. Many people see a projection like $3 per token and assume it would require billions or even hundreds of billions of new dollars to enter the market. But that's not how this works. The price of a coin can skyrocket with surprisingly small amounts of capital, especially in illiquid markets. A few $1 million of concentrated buy pressure can push the price up significantly. And because market cap is derived from price, the market cap can balloon even if the actual capital inflow is relatively modest. This is why understanding how market cap works and how it doesn't is essential for making informed projections. Let's now tackle the elephant in the room, the $3 price target. That's the number floating around on social media. That's what everyone's whispering about in Telegram groups and Discord servers. But let's walk through the math. If this coin is currently valued at around $375 million and is priced at just over 0.4 of a cent, then hitting a $3 price point would require a market cap of approximately $275 billion. That's not a typo. That's a valuation level that would place this coin among the top 3 crypto assets in existence. It would surpass or rival Ethereum and would be worth more than many publicly traded Fortune 500 companies. Let that sink in. We're not talking about growth. We're talking about a fundamental transformation of the project into a household name and a global economic force. It's not impossible, but it's also not probable, at least not in a single cycle. Crypto history has shown us that wild things can happen, but those events are rare, unpredictable, and usually fueled by perfect alignment of market mania, narrative, and adoption. Now here's where it gets interesting and often misunderstood. Many people falsely believe that in order for the coin to hit a $275 billion market cap, $275 billion of fresh capital must be injected into it. That's just not true. In reality, market cap is not a one-to-one reflection of capital inflow. Because of how price and supply interact, especially with low liquidity assets, you can have market cap increases of 10x, 20x, or even 50x with only a fraction of that amount actually being traded. Historically, in explosive bull runs, the actual amount of new capital entering a coin to produce massive increases in market cap has been estimated to be somewhere between 5 to 15% of the final valuation. So for our coin to hypothetically hit $275 billion, the actual required inflow of real-world money might be closer to $27 billion to $40 billion. That's still enormous, of course. We're talking about institutional-level investment, mainstream adoption, and an incredibly strong use case. But it's significantly more plausible than thinking $275 billion needs to be directly invested. That's why education matters. Because understanding these mechanics changes how you view opportunity and risk. Let's dig deeper into what actually moves prices in crypto. 3 key concepts dominate: liquidity, slippage, and psychology. Liquidity refers to how easily a token can be bought or sold without impacting its price. In thinly traded markets, even modest buy or sell orders can cause major price swings. Slippage is what happens when a large order is placed. The price starts to move before the entire order is filled, resulting in a worse average price than expected. These 2 factors combine to create the kind of volatility that characterizes altcoins, which can be a double-edged sword. On one hand, it creates opportunity. On the other, it amplifies risk. But there's a third, less visible driver: investor psychology. The truth is, people don't invest based solely on logic. They invest based on emotion, hype, momentum, and FOMO. The belief that this coin is the next big thing can attract massive waves of buyers. That belief can then turn into a self-fulfilling prophecy if enough people act on it. But the inverse is also true. Fear, uncertainty, and doubt, FUD, can send prices plummeting just as fast. Understanding how psychology impacts markets is what separates gamblers from strategists. So, with all that context, let's ground ourselves in a more realistic, achievable price target for this coin, one that doesn't require institutional miracles or fantasy-level adoption. Based on current momentum, past market cycles, and reasonable capital inflow projections, a price range of 0.40 cent to 0.50 cent is far more feasible. That might sound underwhelming if your sights are set on $3, but let's do the math. At a price of 0.0041 CSNet, hitting 0.40 cent would represent a 97x return. That's a 9,700% gain. That's the kind of return that changes lives, not over years, but in a single market cycle. And it doesn't require global financial disruption. It just requires favorable market conditions, increasing awareness, and continued development. The path to 0.40 CSNet is difficult, but not impossible, especially if Bitcoin continues its bullish trend and altcoins start rallying in its wake. In past cycles, we've seen coins with smaller communities and less compelling tech reach these levels purely based on speculation. If this project has real fundamentals behind it, a 100x is not out of the question. This brings us to a key concept that savvy investors understand well: asymmetric risk-reward. What this means is that your potential upside is far greater than your potential downside. If you invest in a token that's trading for less than half a cent, your total loss is capped. You can't lose more than 100%. But your potential gain? It could be 10x, 50x, or 100x. You don't need the coin to hit $3 to see life-changing gains. Even reaching a fraction of that, dream $3 target, let's say somewhere in the range of 0.10 cent to 0.40 cent, has the potential to change someone's financial reality. especially for those who entered early and held through volatility. A 10x, 50x, or 100x return is not just a number. It's a down payment on a house, the start of a business, debt freedom, or early retirement. It's crucial to understand that investing in smaller cap tokens isn't about betting on perfection or fairy tale outcomes. It's about risk-adjusted opportunity, the possibility that a relatively small investment can produce disproportionately large gains. This is why the early accumulation phase is so important. It's the quiet period, before the headlines, before the euphoria. It's when smart investors are building their positions based on logic, not noise. If you're entering a project because it's trending on Twitter or TikTok, chances are you're already late. But if you're willing to research deeply and act during periods of disinterest or market fatigue, that's where the asymmetric edge lives. And that brings us to one of the most overlooked skills in crypto investing: discipline. It's not enough to find a promising project early. You have to hold through the noise, through the red candles, through the fear-driven dips. Most people don't fail in crypto because they picked the wrong asset. They fail because they sold too early, got shaken out, or abandoned their strategy when things got tough. They jumped from coin to coin, chasing green charts without ever truly understanding what they were buying. Discipline means ignoring hype when everyone's euphoric and staying calm when everyone's panicking. It means having a plan, knowing your entry points, your take-profit levels, and your exit strategy long before emotions take over. And yes, it means accepting that not every project will moon, but that's the nature of asymmetric bets. You don't need every one of them to succeed. Just one or two big winners can carry an entire portfolio. Let's pause here and address an uncomfortable truth. Most people lose money in crypto. That might sound strange in a market where it seems like every other tweet is from someone claiming to have 10x'd their net worth. But the reality is that behind the scenes, the majority of traders and short-term investors end up underwater. Why? Not because they didn't have access to good projects, not because the opportunities weren't there. It's because they lacked patience, emotional control, and a system. They panic bought during peaks, panic sold during dips, or overexposed themselves to volatile assets without understanding the risk. They were seduced by hype and driven by FOMO. They entered positions without knowing the basics like circulating supply, tokenomics, or developer activity. In short, they treated crypto like a casino. And while casinos do make millionaires far more often, they make losers. The antidote to this is education. When you understand how market cap works, how liquidity affects price movement, and how investor psychology drives cycles, you stop playing the game emotionally. You start playing it strategically. In the world of investing, particularly in crypto, the real alpha, the real edge, comes from research. Before putting $1 into any asset, the smart move is to investigate thoroughly. Look beyond the flashy graphics and catchy slogans. Ask tough questions. Who are the developers? What's their track record? Is the community engaged, or is it just bots spamming emojis on Twitter? Are updates happening consistently? What's the long-term vision? Are there working products or just white papers and roadmaps? What partnerships exist, and are they real or exaggerated? These aren't just checkbox items, they're essential signals of health. If a project is all hype and no substance, it won't survive the next bear market. But if it's building steadily, communicating transparently, and attracting organic interest even during slow periods, that's worth paying attention to. The average investor relies on surface-level hype. The exceptional one digs deeper. Here's a powerful mindset shift. Stop treating crypto like a casino and start treating it like a chessboard. In a casino, it's all about luck, noise, and adrenaline. You put money down, spin the wheel, and hope for the best. But on a chessboard, every move is calculated. Every decision is made with the next few steps in mind. That's how professionals operate in this space. They're not guessing, they're planning. They're analyzing sentiment, evaluating fundamentals, and studying market structure. They understand that crypto is cyclical. It moves in waves. There are accumulation phases, expansion phases, distribution, and decline. If you know where you are in the cycle, you can position yourself ahead of time, not react after the move has already happened. This doesn't require a PhD in economics. It requires observation, patience, and discipline. And more than anything, it requires the ability to stay calm while others are either panicking or partying. One of the biggest challenges in crypto is managing expectations, especially during bull markets when everything seems to go up endlessly. This is when the boldest, loudest predictions surface. $10 incoming, $100 soon. Don't miss out. These headlines might feel exciting, but more often than not, they're a trap. They set unrealistic expectations and cause investors to hold too long, believing the next leg up is just around the corner. When reality kicks in and prices retrace, disappointment sets in and people sell at the bottom. It's a painful, avoidable cycle. That's why realistic goal setting is so powerful. Instead of aiming for $3 when the fundamentals don't support it, aim for 0.40 cent or 0.50 and take profits along the way. Set tiers. Maybe you sell 25% of your stack at 0.10 cent, another 25% at 0.25 cent, and so on. This strategy protects your gains, reduces emotional pressure, and still leaves you open to upside. The market will reward those who think like strategists, not dreamers. If you've been in crypto for more than one cycle, you've probably seen this movie before. The coins that exploded in the last bull run were mostly the ones nobody cared about during the bear market. The same will be true in the next cycle. The market is cyclical, euphoric at the top, depressed at the bottom. The only question is, where will you be when the cycle turns again? Will you have built positions in fundamentally sound projects while prices were low? Or will you be chasing green candles when it's already too late? This is why the best investors are often the quietest during hype. They're already in position. They're not trying to catch the move. They're waiting for the rest of the market to catch up. They understand that time in the market beats timing the market, especially in a space as volatile and emotional as crypto. Let's be clear, the most valuable asset you can have in crypto isn't a coin, token, or even cash. It's education. Knowledge compounds in the same way that capital does, and it pays off far more reliably. When you understand market cycles, tokenomics, game theory, and investor psychology, you stop making impulsive decisions. You stop chasing every shiny object. You gain clarity. You gain conviction. And that conviction helps you stay the course when others fold. Crypto will always be volatile. That's not going to change. But volatility is only dangerous if you don't know how to navigate it. For those who do, it's not a threat, it's an opportunity. And the only way to be prepared for that opportunity is to continue learning, questioning, and growing. Don't just follow trends, understand them. At the end of the day, it's important to remember that crypto is not a get-rich-quick scheme, despite what the loudest voices online would have you believe. It's a marathon, one filled with ups and downs, triumphs and setbacks. Yes, the upside can be extraordinary, but so can the risks. The winners in this space are not usually the most brilliant or even the most lucky. They're the ones who stick around. They keep showing up. They keep learning. They don't overextend, and they don't quit when things get hard. They play the long game. So as you look at that $3 dream, don't let it distract you from the real strategy. Focus on what's achievable, what's realistic, and what's sustainable. Even a modest target, if hit with the right timing and discipline, can change your life. And that's what this game is really about. If you found value in this deep dive, if it helped you look at the market a little differently, challenged your assumptions, or gave you tools to make better decisions, then do me a favor. Like the video, share it with someone who's still chasing unrealistic targets, and subscribe to the channel for more content like this. We're not here to pump nonsense or sell dreams. We're here to learn, to analyze, and to grow as informed investors in a chaotic space. Every week, we break down real numbers, real data, and real strategy. So if that's the kind of content you're looking for, stick around. This is just the beginning. Thanks for watching, and I'll see you in the next one.